Sorry, folks, I'm a minute late. My last class ran over a little bit. So welcome back. Any questions before we start? So reminder again that if you have your DCFs done by this Friday, I'd be glad to take a look at them. So if you can, I mean, it's optional. If you don't want to, that's fine as well. And for those of you who've sent in your DCFs, I have a few that came in yesterday and today that I haven't looked at that I'll take a look at and get back to you as soon as I can. I'm kind of backed up here, but I will try to get them back to you. But so don't put too much pressure on yourself, but don't, I mean, there's one DCF that people have just somebody put random numbers in and sent it to me. That's kind of pointless. So at least take a look at your output before you send it to me. Do your first run yourself. That way it'll make my job a little easier, so you're not entering 10% growth in perpetuity with the US dollar valuation, in which case I'm just going to bounce it back and saying, hey, this is a fairy tale. What's the point of my giving you inputs on revenue growth and margins? Right? Let's talk about more on the dark side. So last session, we were talking about valuing young companies, and many of you are valuing young companies, you're wrestling with the numbers, and the reality is you have to make your best estimates and move on. You're going to be wrong, but so what? Everybody else is as well. So today we're going to do more difficult to value companies. So I'm going to throw a few at you, and let's talk a little bit about the issues you run into. Now, one of the things we're going to talk about today, perhaps towards the end of the class, is commodity companies. Commodity companies, their earnings go up and down with commodity prices. So an oil companies' earnings go up when oil prices are high, they go down when oil prices are low. So I'm going to ask you a question. Given that there are these cycles in commodity prices, up and down, would you expect your value to also go through cycles? You see my question? We know oil prices go up and down. Does it mean your value also will go up and down? Parth, what do you think?
I'm not sure, but I would say that the value would increase as the commodity prices increase and then decrease as the commodity prices decrease.
Well, isn't that then an easy way to make money then? Because all you have to do is buy at the low end of the cycle and then you could sell at the high end. So if value goes up and down as prices go down, shouldn't we have an easy way of making money in commodity companies?
That's true. Then perhaps I've made the error of conflating prices with value in this sense.
The example I would think of is, do retail companies' stock prices go up around Christmas, even though we know most of their sales are around Christmas? If people know that that's going to happen, what do? They start building into value, not just on December 24th, they start doing it all through. So the reality is, if it's truly a cycle, and the cycle is predictable, that's the key. If the cycle is predictable, values will actually not go up and down with the cycle. But in the last 20 years, what we've seen actually is more up and down in commodity companies. And the reason is simple. Cycles have become much more unpredictable. I mean, I remember 40 years ago, when you valued an oil company, you asked people, what do you think a normal oil price is? You got an answer with a pretty good sense of reasoning. It's about $35 a barrel, because prices go up and down. They'll show you charts. That's what it. Today, if you ask people what a normal oil price is, just throw up the answer. I have no idea. So we're going to talk about commodity companies in a world where cycles may no longer work, where things have broken down, because that's where I think we are. And ask, what do we do now? How do I value an oil company without a point of view on oil prices? Let's move to the second issue. Sriram, maybe you can help me on this. You're valuing a distressed company. Distress, it's losing money, it's got this big debt overhang, and you do everything you're supposed to do, and you make a realistic set of assumptions. Like what you build the company back to health. So you allow for the fact that they might continue to lose money for the next 3 or 4 years, but your margins improve over time. Your revenue growth goes from negative to positive, and you pay your debt down. So you do this all in the context of a DCF with realistic assumptions, and you come up with a value of $1 billion for the equity. If you stopped right there and told me that's the value of the equity, are you going to give me too high or too low a number relative to the true intrinsic value of the equity? You've done everything right. You made realistic assumptions. Should that $1 billion value be the final value for the company?
I'm guessing it'll be off in some way, and my hunch is that it'll be too high.
Okay, your hunch is right. So tell me, but you made realistic assumptions about revenue growth. You made realistic assumptions about margins. You built in a higher cost of debt. You did everything you were supposed to do in your DCF, right? So what is it about what you did that gave you too high a number?
I'm guessing you didn't account for credit correctly.
Okay, but let's take that out of the picture. Let's say you brought, because the only place to reflect credit isn't the cost of debt, right? So you brought in a realistic picture. But let's dig a little deeper. When you do a DCF, what are you valuing your company as? A going concern that'll make it through whatever troubled times and get out the other end. Does it always happen at companies?
So there's a reasonable chance that that won't happen and that your DCF will die halfway through.
Exactly. The DCF is the value of your company as a going concern. I'm giving you the secret behind why there's a failure probability. Those of you using my spreadsheet, notice the number failed. So what the heck is he doing that for? That is to capture the likelihood that your company will not make it. Today, I want to talk a little bit more about that failure probability, because if you don't incorporate that, you're going to overvalue companies, but there's a significant chance your company will not make it. With young companies, with debt-ridden companies, a DCF, even if you do everything right, will overvalue the equity in the company. Go ahead, Jacob.
Yeah, I just had a question. Maybe you'll cover this later, but even for mature companies, would you say that the probability of failure is always greater than 0?
Yeah, the thing is, if it's 3%, you can gloss over it, right? Because what happens then is it's not just failure, it's what you will get if you sell the assets of the company. So if you're a mature company, you're in a good economy, even if things go bad, even when you sell it, your liquidation value is pretty close to what the value of the ongoing business is. The penalty of ignoring it is very small. This is why, remember, much of what we know in valuation, we built up in the 70s and the 80s, valuing nice, mature, healthy companies. So DCF valuation, there is no failure probability. Nobody cares. It's supposed to be in your cost of debt. So it's in the discount rate. And with 3% or 5% chances of failure, you can get away with that. When it gets to be 15 or 20%, you can no longer do that. So later on today, I'm going to take you through a valuation of Boeing in March of 2020. Boeing is a company with a long and illustrious history. It's one of the largest market cap companies in the US. March of 2020, I had to bring in a failure probability. Peak of the COVID crisis, there was talk that Boeing might not make it through the next 6 months. You have no choice. So that's why there's some companies you can get away ignoring it, but might as well always think about it before you decide to ignore it, because ignoring it is just as much an assumption as bringing in a 3% or 5% or 20%. Okay. One final example, and then, so Rodrigo, you can help me out here. Let's suppose you're valuing a Brazilian company. I'll make this personal. You have a Brazilian company with extremely poor corporate governance. You know what I mean by poor? So there's no chance you can replace the management of the company. The firm is badly managed and badly run. And you've estimated a DCF that already incorporates that and come up with a value of 100 million for the company. You know what I mean by incorporating bad management, right? So what did you do? You put in a low return on capital. You left it low. They never fix it because they don't think there's a problem. Come up with a value of 100 million. I've heard some Brazilian analysts say you should discount the value of these companies for poor corporate governance. Mm-hmm. Would you agree?
No, I think it's already incorporated in the predictions of cash flows and returns in capital. So that's enough. Double count.
And in fact, if you're the analyst, here's what I'd suggest you do. Isolate the variables that reveal the bad management. They say, well, I don't believe you, because that's what you'll hear. Say, this is the input that reflects a bad management. I've left the return on capital at 6%. Your cost of capital is 15%. This company cannot make it and deliver value at the same time. So we're going to talk about emerging market companies, and that's one of the things we're going to talk about is that question of what to do. So let's now go back to the notes, because I left you with the young companies. Today, we're going to talk about a few more cases of what happens in the dark side. Let's talk about valuing mature companies. Now, normally when you value mature companies, you have a much easier task than valuing young companies, right? You have a long history, the company's doing the same thing over and over again every year. They're set in their ways, which is good. Because in terms of prediction, if you're set in your ways, I can see what you did in the past and continue to do it. But can being set in your ways sometimes turn out to be bad? I hate flossing my teeth. I absolutely hate it. It's one of the most detestable things in my life. I'm set in my ways. I don't floss. I tell the dentist when he asks me how I floss every night, I floss like 2 times a week. I'm set in my ways. It's a terrible way, but I'm set in my ways. I can't change easily. And the same thing can happen to companies. They can get set in their ways. They never borrow money because they've never borrowed money. They open 20 new stores because that's what they've always done. But if the world has shifted around you and you continue to be set in your ways, you can get into trouble, right? So some mature companies continue to do the things that used to work in the past, but they've stopped working, but they don't even notice. Because the management is running on inertia and doing what they've always done. Just think, so what? Well, you can value the mature company assuming the status quo continues, right? But let's say an activist investor pops up at this company. You heard, some of you might have heard of what's happening at Kohl's, right? Kohl's, the retailer. There are a group of activist investors are pushing the company to change the way it's run. They're saying, hey, we know you used to be a pretty good retailer, brick and mortar retailer. It's not working anymore. The challenge you face when you have a mature company that's facing transition, in other words, it's facing change, is the value of a company can be very different depending on whether the status quo continues or whether the company changes. In other words, if you think in terms of those 4 questions, what are your cash flows from existing assets? What's the value of growth? How risky are you? And when will you be a mature company? I get 2 very divergent answers depending on who's running the company, whether the existing management continues or whether Bill Ackman or Carl Icahn comes in and puts somebody else running the company. And in those cases, rather than try to bring them all into one valuation, one thing you might consider is actually valuing the company twice. Once with the existing management in place and once with the new management of the activist investor in place. So rather than talk in abstractions, let me pick a company that some of you might have heard of. It's a company called Hormel Foods. You heard of Hormel Foods? Parker, you heard of Hormel Foods? No? Anybody heard of Hormel Foods? You guys never go to the grocery store, I guess. You order takeout so long. I mean, Hormel Foods, the most famous product is a product called, it's Hormel chili, right? Basically, you go into, it's in cans. Almost all their food is canned or processed. But their most famous food item actually is the most disgusting food item ever made in history. It's a product called Spam. Have you heard of Spam? I'll tell you what Spam is, and you're going to feel like throwing up. Spam is ham that comes in a can that has a shelf life that outlasts 2 nuclear winters. Think about it. How the heck do you put meat in a can and make it last 200 years? I don't even want to know what is in there. But there's a little history of Spam that's worth saying. That's kind of a distraction, but still an interesting history. You know how Hormel Foods ended up making Spam? It's in the late 30s, the US Army was mobilizing for the Second World War. Thousands of soldiers were being flown out to Asia and to Europe. And especially on the Asia trip, when they were coming back, it was too long for the US Army to fly them all the way back from, wherever, from Japan or wherever they were, back to the US. So they picked a stopover right in the middle of the Pacific. So guess what's in the middle of the Pacific? What's your only inhabitable place you can think of right in the middle of the Pacific? It's Hawaii. The only problem is Hawaii then is not Hawaii now. There are no big 5-star hotels. It's basically this island with very little food. Thousands of hungry soldiers are landing in Hawaii, and the US Army said, we need something to feed them. And these soldiers were not vegans. So basically, they said, we need to feed them some meat. So they put out a requisition for meat that could be stored without refrigeration. Why? There's no refrigeration. No way to store that much meat. That's how spam was born. That's why if you go to Hawaii still, you have entire cookbooks around spam. It tastes disgusting no matter how they have, spam casserole, stir-fried spam. You basically pick a spam kung fu. Basically, you pick the meat. They made a spam version of it. That's a long story. Hormel Foods has been around 100 and something years. It for a while was run by the Hormel family, but now it's a publicly traded company run by professional managers. But it's set in its ways. It's run by very conservative managers. Conservative in what sense? They reinvest very little. To them, the whole world begins and ends at the US shores. They don't even think about the rest of the world. They reinvest very little. They grow at a very low rate, and they don't use debt. So they're a conservative company in every dimension. So here's the first thing I did. I valued them assuming that the existing management continues to run the company. And guess what? They reinvest very little, so their growth rate is low. They have very low debt that affects their cost of capital. Overall, the value per share that I get with the existing management running the company with their existing reinvestment and debt ratio is about $32 per share. But this was at a time where other food companies were waking up to the potential of a global market and trying to do things more aggressively. So I asked a follow-up question. I said, what if Hormel gets targeted by an activist investor? And that activist investor pushes them to reinvest more, 40% instead of 14%, and use more debt in the company. Not go crazy, not an LBO, but more debt, 40% debt, 60% equity. So two things change. I have a lower cost of capital, I have a higher growth rate. I revalued the company at about $38 per share. So I have two values per share, right? $32 with the existing management running it, $38 with new management running it. The stock was actually trading at about $34 per share. So I was in a quandary. If I compare the 34 to the 32, the stock looks overvalued. But if I compare the 34 to the 38, the stock looks undervalued. So the question I asked was, which of these two numbers should I use? And the answer is neither, right? Some expected value. So here's what I decided to try to assess. I assessed the likelihood that change would come to Hormel Foods. Now, usually what form would the change take? Well, somebody buys shares in the company and puts pressure on the company to change the way it's run. So I looked at the top investors in Hormel. And the largest single investor in Hormel was an entity called the Hormel Foundation. It's a family foundation that controlled the shares that originally belonged to the family. It controlled about 25% of the shares. Now, Hormel Foundation, if they decide to push for change, could clearly get change going, right? So I wanted to see who ran the Hormel Foundation. So I found the documents of the Hormel Foundation. And the chairman of the foundation was the CEO of Hormel Foods. My stomach dropped because you can already see change is not coming here because your largest shareholder is controlled by the CEO of the company. It's unlikely that you're going to tell yourself that you're not doing a good job. So I attached only a 10% chance of change. Why? Because even the foundation could eventually shift, but a 10% chance of change. So my expected value was 90% times 32 plus 10% times 38. My expected value is about $32.50, still lower than the 34. I said, I'm not buying the shares. This could change in a second, right? You know what could change? If tomorrow I woke up and the second largest investor in the group, right below the Hormel Foundation, was Carl Icahn, almost overnight, my probability of change went from 10% to 40%. Think of valuing codes, right? You can do a status quo valuation of codes. You can revalue codes because this activist group has been pretty open about what they want codes to do with the changes put in. And take the probability that that change will come and your expected value will lie somewhere in the middle. So mature companies be open to this possibility of doing two valuations of the company. One with change, one without change, and thinking about that expected value. Now, a couple of loose ends on mature company valuation. When you see mature companies announce restructurings, often with a lot of fanfare, they'll announce how much cost they're going to cut. We're going to cut $500 million in costs. You know what the actual track record is of these costs? Because they make these announcements, the Wall Street Journal will pick it up the next day. 2 years later, you look at the company, in most companies, what's promised and what's actually delivered is wildly different. What's actually delivered as cost cuts is well below what's promised. So McKinsey actually chronicled this, but they asked a follow-up very interesting question: is what is it that's that sets apart companies where you see the cost cuts actually being delivered? And they found two things. One is specific plans at the time of the cost cuts. So if you see a company announce cost cuts with no details at all, trust it less than a company that says, we're cutting costs and here are the places we're going to cut costs. And second, they found that the biggest factor that delivered on cost cuts was what the top managers actually intended, how much they were behind those cost cuts. Sriram?
So in your previous sort of
Mhm.
dual valuation, you assume that like if an activist takes over, it's going to be, I guess, an enlightened version
It doesn't
of the
have to be
management.
it doesn't have to be an activist, right? It basically has to be a change in management. It could just be a change in CEO.
So like
Right? So
you assume that that's like an enlightened version of the CEO.
no, I don't, right? So if you have an activist that's going to damage the company, what would you do differently here? Let's say you're an activist who
You would have a lower value.
you'll get a
share,
lower
right?
value. It's the same process still kicks in, right? It's still an expected value, but now between enlightened status quo and I'm a damaging activist. So in this example, I've created the change is good, but there's nothing in the framework that prevents you from putting a bad frame of reference. So let's say that what people are suggesting at Coles is actually the wrong thing for the company. You revalue the company. You're going to get a lower value, but as an investor, you still have to worry about that, right? Because those activists push through and make the value lower. You're going to face the penalty of that. So the framework still applies. And in this case, I've assumed change in management is good for the company. But if you believe it's bad for the company, nothing stops you from bringing it in.
So how can you tell if like change is potentially imminent without
Well, I
like
think
actual change of shares?
Before if an activist pops up, it's imminent, right? Change is going to happen. Whether it's small or big change or the complete change is really what we debate about. Coles, there's going to be change. How much change is what we debate. One of the things you look at is the sector, because change often comes in bunches in sectors. If you see one restaurant being targeted, it almost increases the odds of every other restaurant being targeted, because activists tend to move in bunches against sectors. And where does change come most frequently? At companies that have done badly. So if you were looking for a subset of companies, it's not going to come at the companies with high margins whose stock price have gone up 50%. It's going to come up at companies. So if you were going through Capital IQ, looking for companies where change is likely, I'd look for companies whose stock prices have dropped, whose margins have declined, the returns are shrinking, because that's where you're going to get people pushing for change, because that's where the payoff to change is going to be greatest.
Okay, thank you.
So let's talk about the second big lesson I learned looking at this. And many mature companies, so if you ask them, what's your problem? Their problem is that we're growing too slowly, right? So the solution that these companies offer in restructuring is let's go for more growth. This is Sriram's point about not all change is good. When you have a mature company with low growth that goes for higher growth, you should always have mixed feelings, and here's why. Remember, I don't know whether we talked about this enough. When we talked about the context of growth, we said growth creates value only if your return on capital exceeds your cost of capital. We talked about what percentage of companies globally have trouble doing that. If you have a mature company in a bad business, the last thing you want this company to do is go for more growth. You see why, right? If they go for more growth, they're going to reinvest to deliver the growth. The net effect is going to be negative. In fact, if you're a company in a bad business, you know the pathway that will deliver the highest value is, right? What should you do as a company? You should look for ways to shrink rather than grow because you're in a bad business. You know how counterintuitive it is to tell managers you should be getting smaller? But that's basically what will deliver the highest value. And finally, I want to talk about debt. And this is where I think activist investors do a terrible job assessing the effects of debt. You know how analysts working for LBO firms assess a cost of capital for a firm after it borrows more money? They keep the cost of equity and the cost of debt fixed numbers, and they change the debt ratio from 20% to 80%. And guess what? Magically, their cost of capital decreases. But that doesn't make any sense. And here's why. When you increase your debt ratio, your cost of equity is going to go up. Think of the mechanism we use, right? When you increase your debt ratio, your levered beta increases, your cost of equity goes up. When you increase your debt ratio, your cost of debt will go up. Why? Because your ratings are going to decline. Your interest coverage ratio is going to get worse. As your debt ratio changes, both the cost of equity and the cost of debt will change. In fact, in my corporate finance class, we spent about 3 sessions optimizing debt ratios. This notion that more debt is better than less debt is completely misplaced. And that's what I've applied here. I've taken Hormel. I've changed the debt ratio from 0 to 90%. So 90% debt would be an LBO. And I've assessed what the cost of capital will be as my debt ratio changes. Initially, as I replace more expensive equity with cheaper debt, my cost of capital decreases. At around 30 to 40% debt, I get the lowest cost of capital. But then after I push beyond that, my cost of capital goes up. Why? Because the benefits of debt are outweighed by the cost. It's not rocket science, but you have to be dynamic. The reason I used a 40% debt ratio for Hormel in their restructured state was because that's what they can afford to take. It's not based on industry averages, not a target debt ratio. It's a debt ratio that minimizes their cost of capital. Now, if you want to take Sriram's point and take an activist who uses a 90% debt ratio, I can almost guarantee you the value you're going to get is going to be much lower than the value today, because by putting in a 90% debt ratio, you pushed your company further away from its optimal debt ratio than it already was, but just in the other direction. Any questions on the mechanics of cost of capital and debt ratios? Go ahead, Tim.
Yeah, so I get that there's a certain financial engineering method to take to find the correct debt ratio, but then what happened between 80% to 90%? Like, considering other 10% changes, like it's extremely high changes in beta and cost of equity.
In fact, there's going to be tipping points. Basically, the tipping point arrives when you're so close to triple C, single B that it's no longer a question of cost of capital. You're just not going to survive because you've hit a debt point where you might not make it through the next year. So whenever you look at ratings, when you go from AA to single A, not a big deal. Single A to triple B, you're not as happy. Triple B to double B already are at one tipping point. You know why? What's the magic of triple B? It's the line between investment grade bonds and non-investment grade bonds.
Yeah.
So when you drop below triple B, already there are some things you can no longer do. Suppliers, for instance, might demand cash. Okay, so those are the tipping points where you get the sudden soaring of the cost of capital, and that's effectively, so for most companies, it happens around 40 or 50%. You don't even need to get to 80. You get that tipping point. And that's why when you're borrowing money, you've got to be really careful to stay away from those tipping points.
Thank you.
Let's talk about valuing companies in decline and distress. I'll tell you the biggest problem you will face in valuing declining companies is a psychological problem. Let me explain. When you sit down to value a declining company, and some of you are, what's the first thing you're going to see when you look at the history? You'll see revenues shrinking, not growing, and margins coming under pressure. When I ask you what the value of growth is, you start laughing. What growth, right? Because the growth is all in the past. And your risk can shift over time if you're shrinking as a company because you're getting rid of businesses to get smaller. And finally, I ask you, when are you going to become a mature firm? You're going to say, it was 20 years ago. I was mature then. Now I'm beyond mature. With declining companies, as I said, the biggest issue you face is a psychological issue. Let me explain what that psychological issue is. Often when I talk to appraisers and equity research analysts, and these are people who've been valuing companies for 30 or 40 years, I ask them a question. And I'm going to ask you this question as well, if any of you have been doing valuations for a while. When was the last time you valued a company where you put in negative growth rates all the way through? You know what the answer in most cases is? No, many of these people have been valuing companies for 40 years. They've never valued a company putting in minus 5% growth in year one, minus 5%, because it seems almost unnatural. As human beings, we're hardwired to be optimists. And this is the exact opposite of that, right? But let's face reality. Are there some companies where you look at the future and you see less revenues? Absolutely. So why are we so psychologically opposed to doing it? I'm not sure, but that's the biggest challenge you face. So here's an example. Or incidentally, when you are looking at a company like this in a bad business, a good management will make your company smaller. That's your best case scenario. You know what a bad management could do? They can push for more growth. They will get the growth, but the price they pay will be so high, you wish they hadn't gone for it. So as an example, I'm going to show you a valuation I did of JCPenney. And this was an optimistic valuation a few years ago. You should see the valuations I would do of JCPenney today. You don't want to see them. They're that depressing. It's a few years ago when I was a little more upbeat about JCPenney. And this is what my upbeat valuation looked like of the company. I projected negative revenue growth for the next almost 7 years. You know what negative revenue growth here is? This is JCPenney shutting down stores in the worst parts of their business. So let's say your big city stores are terrible investments, but your small town, your suburban stores are doing well. JCPenney is shutting its big city stores. That's what the negative revenue growth is. But when you're shutting stores, remember, you're not reinvesting money, you're taking money out of the business. Now, in the case of retailers, that might be a little more difficult because you're not liquidating assets, but you're getting out of leases. And your lessor might say, if you get out of your lease and you allow me to lease it to somebody else, I'll pay you $1 million. See this negative reinvestment number? That's basically the company shrinking. It's not investing money, it's taking money out of the business. So here's a story of a shrinking company. You're saying, why is this an upbeat story? Because eventually I hope that JCPenney can get small enough that it can go back to being a regular company where maybe the core business for JCPenney is suburban mall stores, and that's all you do is suburban mall stores. And that company will have a regular growth rate. And so my terminal value, I'm assuming that eventually a smaller version of JCPenney is able to rediscover some core business that still works and continue with that business. Now, you could disagree with me on this. For you, the end game could be that there is going to be no leveling off, no core business, that this business will continue to shrink after year 10. So what would you do differently in this valuation if you thought the company would continue to shrink after year 10? Nick, what would you do differently?
Nick, me?
Yeah.
Okay. So possibly if they might continue shrinking, you let's say you just make a different like schedule of growths and like.
That'll mean, do you really want to go there? Because that'll mean you have to do year 11, year 12, year 13, year 14, year 15. So could you stay with the terminal value structure I have and assume a negative? You see what the question I'm asking is, can you have a perpetual growth equation with a negative growth rate?
I see. That's the question.
So if you put in minus 5% growth forever after year 10, you know what you're going to do? Your terminal value equation will still work. It'll give you a lower number, but essentially you're making your company shrink and disappear. You're valuing a fossil fuel company. That might be a more realistic assumption than assuming that we will keep getting oil out of the ground every year forever. So that's the first opening. Remember that in your terminal value, your growth rate in perpetuity doesn't have to be positive. It could be negative. What's the other scenario? An even worse scenario. At the end of year 10, you shut the business down. You liquidate it. Now, your liquidation value is not going to be a cash flow value. It's what can I get from selling the assets? So leave open that possibility with the declining firm is when you get to your terminal value, you could have a negative growth rate in perpetuity or a liquidation value as your terminal value. Any questions on decline? Now I'm going to take a declining company and add, Sriram, is your hand up from before or is it?
Oh yeah, sorry, I don't have a question.
It's okay, I just want to make sure. Now let me take this declining company and put it a bomb in the middle of the company that can threaten to blow up. And here's what I mean by this. If you have a declining company with a lot of debt, you see what the worry now becomes is your revenues are shrinking, your margins are coming down, your earnings are coming down. If you don't pay off the debt as you're shrinking, eventually your company is going to blow up. This is not always the case. With declining companies, you have to worry about distress, the chance your company will not make it. So, and if you have distress, then you can't stop at your DCF, because if you stop at the DCF, if valuing a company as a going concern, you got to ask two other questions. One is, what is the chance my company will not make it? That failure probability. And second is, if I don't make it, how much will I get as an equity investor? Because if you don't make it, what happens? Your lenders will sell off your assets, they will liquidate the assets, they will pay off the debt. And if there's any money left over, you get it as equity investors. But if there's nothing left over, you get nothing. So I'm going to use a company that some of you might be familiar with to illustrate this process. You've heard of Las Vegas Sands? You've heard of Las Vegas, right? Las Vegas business is a casino business. Las Vegas Sands is a large casino company. And here's something I want to say about casino companies before we go any further. And you might view this as a negative, but it's actually a description of how most casino companies operate. Is casino companies tend to be operated, both founded and operated by megalomaniacs. Okay, so think of Wynn Resorts and Steve Wynn. These are people who are larger than life, Napoleon complex, incredibly power hungry. So keep that in the background, because I'm going to give you a description of Las Vegas Sands, and you're going to see how it got into the trouble that it was in February 2009. Las Vegas Sands was founded and majority owned by a guy called Sheldon Adelson. He just died a few months ago, a few weeks ago. Sheldon Adelson owned 51% of Las Vegas Sands. So hold on to that 51%. And during 2008, Las Vegas Sands was one of the fastest growing casino companies in the world. So it was opening casinos in Vegas, obviously, but in Macau. It built this place in Singapore called Marina Bay Sands. Some of those of you been to Singapore might have seen this huge, but every one of these casinos was a huge, monstrous property, costing hundreds of millions of dollars to build. So it's growing, it's building new casinos. Now, normally when you are a company growing and making these big investments, you got to raise capital, right? And what are the two ways you can raise capital? You can issue shares and raise equity, or you can borrow money. You know how Las Vegas Sands funded every single one of these casinos? Entirely with debt. You're saying why? What did I say? Las Vegas, Sheldon Adelson owned what percentage of the company? 51%. And how did I describe every founder? Megalomaniac. You're a megalomaniac, owns 51%. You can see very quickly why he or she will never issue new shares, because you're afraid of losing control. So it's growing, it's borrowing money, building more casinos. And as long as times were good, people went along with it. Equity research analysts loved the company. And then you ran headlong into 2008. 2008, of course, you got the crisis, and the crisis affected Las Vegas Sands in both their operating and their financial dimensions. First, people stopped coming to casinos. They're afraid to fly. The casino business imploded. And the people you owed money to were no longer sanguine. They wanted to say, can I get paid now? When am I? What covenants are going to add? So by February of 2009, when I valued Las Vegas Sands, there was talk that Las Vegas Sands might not make it. There was a lot of talk. There were, in fact, people who were convinced that Las Vegas Sands wouldn't make it through the next 6 months. So here's what I did. I shut off all that negative chatter, and I did a discounted cash flow valuation where I fixed Las Vegas Sands and made it a healthy company. You know what fixing Las Vegas Sands means, right? So here's what I did in my spreadsheet. I brought the revenue growth back. That's people coming back to casinos. I improved the margins over time. That's as they become a healthier business, their margins improve. And I brought the debt ratio down, because as they got healthier, I said they're going to pay off the debt and make themselves into a healthier company. So on my spreadsheet, I fixed them, made them a healthy company, and put them in year 10, gave them this big terminal value. Nirvana is here. discounted it all back. I came up with a value per share of $8.12. So I'm fixing the company in my spreadsheet, making it a healthy company, coming up with a value of $8.12. Stock was trading at $4.25. The obvious question I was asked was, are you buying? And I said no, which led to some soul searching, right? If the value I'm getting is $8.12 and the stock price is $4.25, what's holding me back? You know what was holding me back? All that story, all those stories I was reading about Las Vegas Sands not being able to make it. Think about it. The $8.12 is the value per share of Las Vegas Sands makes it as a going concern. What am I worried about? That they will not make it. If I can somehow attach a probability to that number, that they would not make it, I could be home free, right? And here I got lucky. I found a Las Vegas Sands corporate bond. It was a 7-year bond that was trading at $5.29. Let me back up. Bonds are usually priced at $1,000 per bond. So if you issue a bond at par value, which is what most companies do, you get $1,000. The price is $1,000. And with healthy companies, the price stays around $1,000, right? Because it depends on the coupon rate and the interest rate. This bond was trading at $5.29. So what does that tell you? The bond market is worried about distress. And normally the way we price bonds is we take the promised coupons. In this case, the coupon is about $63.75 a year, 6.375%. We discount those promised coupons in the face value at a risk-adjusted discount rate, right? Based on default spreads or ratings. I'm going to do something slightly different. Instead of taking the promised coupons, I'm going to take the expected coupons. You're saying, what the heck is an expected coupon? Remember, to get the promised coupon, the company still got to be around. So I attached a probability that the company would not make it. So if it doesn't make it, I'm not going to get the coupon. So I'm now adjusting the cash flows for distress. Remember when we did certainty equivalent cash flows, what I said you could do? If you adjust the cash flows, then you don't have to use a risk. So I'm using the risk-free rate as my discount rate. So let's see where we are. I know the price of the bond. I know the promised coupons in the face value. I know the risk-free rate, right? Take a look at that equation. What's the only thing I don't know? I don't know the probability that you will not make it. I used to solve a function in Excel. I said, I'll give you the price, $5.29. Coupon is $63.75. $1,000 at the end of 7 years. The risk-free rate is 3%. What would the probability of failure have to be to explain the price? And the answer I got was mind-boggling. It was about 13.5% a year. There's a 13.5% chance of failure built in every year. And remember, if I have to make it through 10 years to nirvana, and there's a 13.5% chance I'll fail every year, there's only a 23% chance I make it to nirvana. What the bond market was saying is there's a 23% chance you'll make it as a going concern, a 77% chance you will not make it. And if you will not make it, guess what's going to happen? The banks are going to take over. They're going to try to sell your casinos. Let's get real. When they try to sell those casinos, how many potential buyers do you think you can get for a $500 million monstrosity in Las Vegas? Would you be able to invest? No, I don't think so. In fact, the only people interested in buying a casino would be another casino, right? The only problem is you try to sell your casino in 2009. What are the other casinos? They're all in trouble. None of them is looking healthy. So guess what? If you try to sell your casinos, you take a massive hit. Or even the book value. You know where I'm leading, right? If they're forced into bankruptcy, I can almost guarantee you my equity is going to be worth nothing. There's not going to be enough money to pay the debt and have anything left over. So here's what I have. I have $8.12. The 23% of the time, Las Vegas Sands makes it as a going concern. But the remaining 77% of the time, my equity is worth nothing. My expected value is $1.92. When you face a company with substantial distress, that's why I put in that failure probability into your spreadsheet, because without it, you're going to overvalue troubled companies, because you're going to fix every problem in the spreadsheet. It's so easy to do. You're going to lower the debt ratio, give them this nice big terminal value, and then you're going to tell me to buy the stock, and I'm going to listen to you and buy the stock, and 3 months later, the company's going to go into bankruptcy. And I'm going to ask you what happened. He said, well, I never built that in. That's what we're trying to do. when we bring it in. And just to show you, it's not just deeply distressed companies. Every company has a potential chance that this could happen to it. And this is a point that I think Jacob raised, which is, hey, why are we doing this just for distressed companies? Should we do this for every company? And the answer is probably yes. Because if nothing else, it will force us to think about this failure probably more seriously, right? Because right now we just brush it off. So when I valued Boeing in March of 2020, in the midst of the COVID crisis, I came up with a value assuming they'd make it back. After all, Boeing is a duopoly. If it survives, it's going to come back. The revenues are going to come back. Airlines still have to buy aircraft. So I could see that happening. But in March of 2020, this is the peak of the crisis, there was a very real chance that Boeing might not be able to make it. And it doesn't mean that Boeing would have to go bankrupt. They might have to go the GM route. Remember GM in 2009, the US government had to step in and save the company. My guess is the US government could step in and save Boeing, but in return for saving Boeing, you know what will happen to your equity? The same thing that happened to GM's equity in 2009, it gets wiped out. That's the equity value of zero. So when I valued Boeing in 2009, I built in a 20% chance of profit. I still found the stock to be undervalued. I actually bought Boeing in March of 2020. But my point is, I'm bringing in the likelihood of failure. Without attaching it, my value would be much higher, but it would be a much more unrealistic value. Uli?
Professor, I was just wondering, intuitively, how does the bond market know the probability of failure for a company?
It doesn't, right? Because I mean, but when you price a bond, aren't you, whether you intuitively or not, basically you have to factor in the company's credit history. You have to factor in how big or small it is. And so it's a way you loan money to a friend. How do you decide whether you're going to be paid back? If I told you the last 3 times you lend money to the friend, you never saw the money, I'll say your default probability is close to 100%. You lend money to a friend who's got a lot of money floating around, they pay you back the next day, and they have a history of doing this, you have a much higher probability. It's never quite 100%. A car could run over your friend, you don't have any contract to show that you lent him the money might be gone. But that's what we assess probabilities on. We look at the health of the company, we look at its capacity, we look at its history, and all those things feed in. But every time you buy a corporate bond, whether you like it or not, you're making those assessments, right? And all I'm doing is making them explicit based on the price you're willing to pay.
Makes sense. Thank you.
Yeah. Sriram?
Could you retool this model almost for really young startups and just only project out the optimist scenario and just?
This is actually a good way to think about young startups, because when I valued Amazon in 2000, remember I made a confession when I did the valuation, the negative cash flows the next 7 years. I came up with a value and I left it at that value. So what was I saying in early 2000? There's no chance that the company will fail, right? Because that's implicit. Explicitly, what I think we should do with young companies is think about the probability of failure, no matter how much potential a company has and how great the company is. You're a young money-losing company, there's a chance you will fail. That's why I valued Airbnb. I still left a 10% chance of failure. With Uber, it was higher because I think the business model is more informed. The difference is it's easier to assess this probability of failure for the Las Vegas Sands and the Boeings of the world. You know why? What do I have for these companies that makes me come up with a better assessment? These companies tend to have bond ratings. Why? Because they borrow money. And with bond ratings, I have a history. If you're BBB rated, based on history, there's about a 10% chance of failure. If you're single B rated, that probability of failure goes up to 20%. So I can look at the history of B rated, BB. So if you have a rating for a company, attaching this, coming up with this number becomes a little easier. But with the young companies, it's a little more subjective because you're basing it on how close are they to making money, how much cash they have, what are the chances that something bad can happen to them. But don't think of it as optimistic and pessimistic. Think of it as going concern and not going concern. Because if you start to take the going concern and start splitting it up to scenarios, you're going to drive yourself crazy. right? So, and you can, right? Because the decision trees here, you can make optimistic, base case, pessimistic, and then take the optimistic, so you just have to know when to stop when you do the scenario analysis, but you can actually build back to an expected value by making the decision tree fuller. Alex?
Yes, Professor. If we're dealing with a company which is of strategic importance to a country, and it's almost guaranteed that the government is going to step in if the
But
company
doesn't mean your equity is going to be protected, right? So be very careful. A company can survive and your equity can still be wiped out. That's why I use the GM example. GM survived because the US government decided that GM was too big to fail, that had too many employees, was a company that did not want to disappear. It succeeded, survived as a company. But the equity investors in GM in 2009 essentially got wiped out. So when GM came back to the market, new equity was issued, but none of the old equity investors got any of that money. So it is true a company can be of strategic importance. The government will not let it fail, but that doesn't mean the equity in this company is protected by that guarantee, because that's a very different claim that you have. The government can save the company and then throw you to the wayside.
Mm-hmm. But from a more practical standpoint, do we just incorporate it just as the probability of failure in our model?
You can do a probability of a government stepping in and ask, well, if a government steps in, what will happen to the value of my equity? So that failure probability is basically from the perspective of equity investors in a going concern. So the company might survive, but do the equity investors make it?
Got it. Thanks.
Sebastian?
So what if a young company has as like its majority investor a large mature company? Is there ways would you use the mature company's failure probability because they're pretty much they want to guarantee their investment?
I know this is politically correct, but it's got a sugar daddy.
Yeah, exactly.
Basically, that's what it is. It's sugar daddy saying, you know what, no matter how much you spend, I'll make up the difference. And so what that means is that same company could potentially be worth more than an otherwise similar company without that backing, because the failure probability could be 0%, right? The only problem is nothing comes for free. So in return for being the sugar daddy, what does a company usually require of the startup? That their R&D be directed in a particular way, because let's face it, your reason Microsoft is backing you up is not because they love you as a company, but because they think you're doing something that they can benefit from. So the only thing I would suggest is if in fact there's a big company as your backer, build it in not only through a lower failure probability, but in terms of what your margins might be, right? So if your biggest customer is Microsoft, guess what? Your margins will be a lot lower than if you did not have them as an equity investor, because they're going to say, look, I've allowed you to get to where you are now. We're not going to pay you this premium price you're demanding. We're going to pay you half of that. So build it into every aspect of your evaluation. Otherwise, every company is going to go out there looking for a strategic partner in a big company, because you're always going to get a higher value. The reason young companies often choose not to go that route is it comes with consequences for their margins, their growth, and they don't want to kind of lock themselves in, even if it means a lower chance of failure.
Thank you.
So now let's move to emerging market companies. I mean, you ask exactly the same question of emerging market companies as developed market companies: cash flows, growth, risk, and when will you be a mature company? But here's, I think, the reality. With emerging market companies, every time you ask a question about the company, you know what's lurking in the background? You ask, how risky are you to a Brazilian company? The Brazilian company can give you an honest answer about their risk, but what do they not control? The country risk, right? The country is behind the company in almost every single question. If the country is doing well, the company will also do well. The country is doing badly, you're basically, it's like an uphill climb. So country risk is a clear and present danger when you think about valuing emerging market companies. It goes without saying that if you really don't understand, how Honduras works, you probably shouldn't be investing in Honduran companies, because you're going to constantly be surprised at what you're getting hit with. But when you incorporate country risk into valuation, my advice to you is that you use a scalpel. not a butcher knife. What I mean by that is pick one place in your valuation to bring in country risk so that you can see what it is. And you know where I pick to bring in country risk. You don't have to do what I do, but where do I bring in country risk in evaluation? What's the only place?
It's the cost of equity.
Through the equity risk premium in the cost of equity. Now, if you want to do a land and a country risk premium, you can do it. But once I've done that, I let it go. I don't take the cash flows for a Brazilian company and bring them down, and I don't take the growth. So don't hit the company multiple times for the same reason. If you're worried about emerging market risk, bring it into your cost of equity, and cost of debt as well. Remember, your cost of debt includes a country default spread. Your cost of capital will carry that burden. Second, if you're spending a lot of time on valuing an emerging market company trying to decide which currency to use in your valuation, stop. You know why, right? What do we say about currencies? Pick a currency and be consistent. And I said, if you pick a currency and you're consistent, that your cash flows, your growth rates, your discount rates are all in that currency, you should get the same value for your company, no matter which currency you pick. Whenever I say this in an emerging market audience, people look at it and say, they're right. So I've stopped just saying this, and I'm going to give you an explicit example of how currency change affects valuation. So I'm going to use a company called Infosys. It's one of India's largest outsourcing / software companies. And I valued Infosys in Indian rupees. This was in 2017. And then I revalued Infosys at exactly the same point in time in US dollars. So you ready? I'm going to give you the good news first of moving to dollars, and then I'll give you the bad news. When I value Infosys in US dollars, I get a lower cost of capital than when I value it in rupees. Peter, why is that? Peter, why would I get a lower cost of capital in dollars than in rupees? Not sure. Want to pass it on? Go ahead. You're still muted, though. I can't tell.
I guess because of inflation.
Exactly. It's only inflation, right? It's not country risk. Country risk is in both dollar and so I have a lower cost of capital. This is good, right? Lower discount rates. That's the good news. But when I look at the growth rates, remember the growth rates for Infosys, originally my rupee valuation were 12%, they dropped to 8.78%. You know why? For exactly the same reasons, lower inflation. So I have lower discount rates, lower growth rates. The bottom line is when I get the value per share in dollar terms, I get exactly the same value per share in rupees and dollars, because what one hand gives you, the other hand takes away. The discount rate hand makes me feel better, but then the growth hand takes that away. That's why when you value emerging market companies, it's more critical that you stay consistent than that you find the right currency to use. So if you're valuing a Venezuelan company and you're getting really, really frustrated because you cannot get a Bolivar risk-free rate, just do the entire valuation in US dollars or Brazilian reais or whatever currency you pick. Don't stay stuck in currencies, and definitely try to be internally consistent. Now let's talk about the corporate governance track. This is not true just for Asian, not just true for emerging market companies. It's true pretty much for any company where you have very little say in the management, is you're stuck with the existing management. And many of these companies, often the company could be badly managed and badly run. Everybody knows it, but nobody can do a thing. It's family controlled. So often when analysts run into these companies in emerging markets, they attach arbitrary discounts to the value, saying this is, corporate governance is bad. And as Rodrigo mentioned at the start of the class, if you've done your job right, there should be no need for discounts. It should already be embedded in your valuation. So I'm going to give you an example. And it's a South Indian company that I've known since I was like 5 years old. My family's, I've known the family that runs this company. And their family group, now it's a publicly traded company. And a few years ago, 15 years ago, maybe it's not a few years ago, quite a while ago, I was back in India, and the people who ran this company came to me and said, would you come into the company and talk to our top management about the value of our company? And I said, why? They said, market's not being fair to us. It's trades. We're trading at about like 5 times earnings, but we're a money-making company that's growing. We don't know why the market is being so punitive. So can you come in and invest? So basically what they wanted me to come in and say is, you know what, you're right. The market's being unfair to you. You should really trade at 8 times earnings. So I went in with an open mind and I valued the company. And as I value the company, I want you to tell me why, as an investor, you might be concerned about investing in this company. So here's what I saw. They were a money-making company. On that, they were right. They were very aggressively reinvesting. In fact, they reinvested almost 113% of their after-tax operating in the previous year. But if you average out across time, they've been reinvesting about 60% of their after-tax operating income every year. They're making about a 9.2% return on capital. So they're making money on their projects. You take the product of those two, gives me a growth rate of 5.5%. So you can see where they're coming from. We're growing 5.5% a year. We're making money. We should be worth a lot, right? Now, what do I need to check before I can say right with them? I check their cost of capital. And this was when the Indian rupee risk-free rate was about 12%. The cost of capital I had in rupee terms was 16.90%. You see the core of their problems? They're growing, they're reinvesting a lot, but they're growing by taking investments that deliver well below the cost of capital. And remember, every time you do that, what are you doing to your value? You're reducing your value. I assume they would continue to do this forever. You know why? Because they don't think there's a problem. They think they're making money, they're growing. What's the big deal? What's the incentive to change? If you already think everything's okay, you're not going to change. And if I leave everything as is, the value per share that I get is 62 rupees. They're actually trading at 102. They thought they were being underpriced at 102. I think they're being overpriced. They should really be trading at 62. They were shocked. And they pushed back. They said, well, you lowered the reinvestment rate a lot. We can reinvest much more. I said, okay. How much? They said, I think 80%. Let's put in a reinvestment rate of 80% here. What's going to happen to my growth rate? 80% times 9 gives me a 7. So I said, you get a higher growth rate. So there. Then I showed them the value. You know what happened to the value when I used an 80% reinvestment rate? Do you think it went down or up? You're reinvesting even more in projects that earn less than the cost of capital. $62 became 53. If they thought the answer is we can grow faster, that's not the right answer. That's not going to push up your value. I made them kind of figure out what they had to do. You know what the problem here is? It's not that they're reinvesting enough, it's that they're reinvesting badly. So what do they need to fix? They need to find higher returns on capital on their investments. So I said, no, we can make 12%. I'm not asking for miracles. This is not even high enough to cover your cost of capital. But if you can move in the right direction, your value per share will increase. Or here's the other thing you can do. If you make your reinvestment rate go from 60% to 0%, what's going to happen to your growth rate? It's going to become 0. But you know what happens to value per share? It becomes $120 per share. Because when you grow and you take bad investments, you're reducing value, and reducing that growth, maybe even making it go away, will actually increase your value. In fact, there are 2 drags here. One is that the new projects they're taking continue to earn less than the cost of capital. The other is their existing projects also earn less than the cost of capital. The first one they can fix easy, just stop taking new projects. The existing projects, though, much more difficult to fix because you're kind of locked in. You've already made those investments. Tough to get your money back out of them. So when you think about corporate governance, it is a problem at any company where you don't have power, but it's more of a problem when you have a company that's badly managed and badly run. A little later in this class, we're going to talk about the value of control, especially in acquisitions. You have a company that's badly managed and badly run, not having the power to change management can have significant consequences, as you can see in the value per share. Because if this company had good corporate governance, you know what would happen, right? At some point, an activist is going to pop up and say, why do you guys keep opening stores when you keep earning 9%, the cost of capital is 16%? Just stop. That's all you need to do to increase the value per share in the company, is to actually stop investing badly. Now, when we talked about loose ends, we talked about cross holdings, and I talked about the mess that cross holdings create, right? So difficult to value them. Often you're trusting accountants. And again, this is not just specific to emerging market companies, but it's more of a problem in Asia and Latin America because of the histories of these companies. They tend to have more cross holdings. So I'm going to show you an example of how cross holdings can play out in family group companies. Now, before I show you the next page, don't even try to read the numbers on this page. They're impossible to read. They're just too small. But trust me on this one, because I'm going to give you the big picture of what I was doing in this page. I valued 4 companies in the Tata Group. Tata Group is one of India's oldest and best regarded family groups of companies. And I valued, this was about 2010, I valued Tata Steel, Tata Chemicals, Tata Motors, and a company called Tata Consulting Services. All publicly traded companies, all part of the Tata family group. See, I did all the standard things, right? We had free cash for the firm, cost of capital, so I valued each company. But remember, to mop up loose ends, what do I need to do? I need to bring in cash, I need to bring in cross holdings and subtract out debt. So I'll cut to the chase. Here's what I found at the 4 companies. The blue is actually the portion of my value that comes from discounting free cash flows of the firm at the cost of capital. See the red? That's a portion of my value that comes from cross holdings. Notice that for Tata Chemicals and Tata Steel, 47 to 48% of my value comes from cross holdings. For Tata Motors, it's slightly less, 37%. For Tata Consulting Services, it's actually about 5%. So I have a question. What is it about? They're all part of the same family group. So why is Tata Consulting Services have less cross holdings than Tata Motors, Tata Steel, and Tata Chemicals? Anybody want to give that a shot? I mean, they're all part of the same family group. Why is so much more of my value coming from cross holdings at Tata Motors, Tata Steel? Evan?
Does it have something to do with the fact that Tata Consultancy Services earn the most amount of their revenues from outside of India, while the others do?
It's one area where they're different, but that doesn't explain cross holdings, right? Because in a sense, the two are kind of separate issues. But what else is different about Tata Consulting Services? Which of these is the youngest of the 4 companies? Tata Consulting Services has been around only like 25 years. It's a software outsourcing company. Tata Motors, Tata Steel, and Tata Chemicals have been around for almost 100 years. You think, so what? For the bulk of their lives, they used to be part of a family group which was privately held. The family basically ran all the companies, they owned all the companies. So let's say it was 1965. Tata Motors has had a really good year, and Tata Steel needs to build a new plant. You know what the family did? They went to Tata Motors, they had a good year. They took the earnings. After all, they own all the companies, they're allowed to do that. They took Tata Motors' earnings and invested in Tata Steel. But they did the accounting right. When you do that, you give Tata Motors these hypothetical shares in Tata Steel. They're all 100% owned by you. You really don't care. You see where I'm going? These companies eventually went public in the 1960s and 70s. But by the time they went public, they reflected their history, which is they were that internal capital movement that shows up as cross holdings. Younger companies have less cross holdings because they weren't around during that period. By the time Tata Consulting Services went public, every other Tata company had already gone public. They didn't have this intra-group capital market to fund. What I'm trying to say is when you see cross holdings in your company, before you curse the company and think it's a conspiracy out to get you, remember, it might just reflect their history as a company. But here's how it played out. Ultimately, why do we value companies? Because we want to act on those valuations, right? And I'll tell you what this particular chart tells me. I am far less likely to buy Tata Motors, Tata Steel, and Tata Chemicals if I find them undervalued than if I find Tata Consulting Services undervalued. Do you see why? Because the Tata Consulting Services, if I find it undervalued, the bulk of my value came from my work on cash flows and growth. And I could be wrong, but it was my intrinsic valuation. Whereas with Tata Motors, Tata Steel, and Tata Chemicals, the bulk of the value comes from these cross holdings. And where did I get them? By trusting the accountants. When half your value comes from the book value of the holdings, you're far less likely to act on that valuation because you don't have as much faith. That's how it plays out for me. When I value cross-holding companies, I require a much bigger margin of safety, a much bigger difference in price and value before I act, because so much more of that value is out of my control. And my final point for today, truncation risk. Rodrigo, go ahead.
Yeah, Professor, did you price the minority holdings, or is it that just book value?
I used a price to book, but it's still back of the envelope, right? A price to book is not intrinsic valuation. So I did what I was supposed to do. I took the book value, I tried to convert them to a market value, but the reality is it's still a very rough approximation. I don't feel as much faith in that pricing as I do in the intrinsic valuation. Truncation risk. What's truncation risk? Risk you will not make it to year 2 or 3. We talked about one dimension, which is distress, but that's not the only one, right? Now, I was in Antigua, in doing a valuation seminar. Why was I in Antigua doing a valuation seminar? It's the middle of winter in New York. It was really cold. Some guy in Antigua called me and said, "Can you come over and talk about valuation?" I said, "I'll just come to Antigua. It's nice and warm. It's an island. The beaches are there." So I was there, and so this group of business owners in Antigua, there aren't a whole lot of publicly traded companies. So I asked them, "What's your biggest risk?" Expecting things like tourism revenues will be up or down, or there'll be tax issues or regular. Not the biggest risk each of them worried about is that a hurricane would hit Antigua, and many of them are in the tourism business, that hurricane would essentially destroy or devastate their hotel. Natural disasters can create truncation risk. I remember valuing an Egyptian hotel company, and this is actually an Egyptian hotel company that saw its value go from a few $100 million to zero. You know why? Because they had one base, luxury hotel property in Egypt, I don't know where in Egypt, that got hit in a terrorism attack and got essentially wiped out. So political risk, terrorism risk, nationalization risk are all truncation risk. And those are risks that do not fit easily into discount rates. So if you ask me, how do I increase the discount rate for the fact that I could be nationalized? I don't have an answer for you, but I can give you a different way of dealing with it. And I'm going to use, and this is our final example, Aramco to illustrate this. As many of you remember, Aramco went public in 2019. And one of the interesting things about Aramco is the minute it went public, it instantaneously became the largest market cap company in the world. And where does Aramco get its value? It gets its value from 300 million barrels of oil under the Saudi sands with the lowest cost of extracting the oil of any oil company in the world. So it's a very simple company to value. In fact, it made life even simpler because it offered a guaranteed dividend. As part of their IPO, they promised a dividend of at least 75 million in year 1. So the first thing I did was I did a standard dividend discount model. I treated it like a bond, basically, dividends growing at 1% a year, came up with a value of 1.63 trillion. So you could just collect dividends and be worth 1.63 trillion. But the question often when you have dividends is, can they really afford to pay it? The answer with Aramco is absolutely. In fact, their free cash flow equity, which is potential dividend, was 108 billion. I actually did a free cash flow equity valuation where I gave them a slightly higher growth rate and more risk because these free cash flows equity are more volatile. The value that I got was about 1.65 billion. So basically, I'm stuck around 1.65 billion. But here's my biggest worry when I invest in Aramco. It's not that they will not be able to sell the oil. It's not even that oil prices will change. It's that by investing in Aramco, I'm exposing myself. Because remember, Aramco is not just a publicly traded company, it's Saudi Arabia, the country. 80% of Saudi Arabia's GDP comes from Aramco. So when you invest in Aramco, you're investing in a country, not a company. And it gets a little worse, right? You're not just investing in a country, you're investing in a royal family. Whether you like it or not, your investment in Aramco is a joint bet on oil and the Saudi royal family staying in power. So you see what the truncation risk here is? You value Aramco at 1.65 billion. What are you worried about? That there'll be a regime change. Let's take the most extreme scenario. Let's say you're incredibly pessimistic about the future in the Middle East. You believe that there's regime change is imminent. And that the minute it happens, they're going to nationalize Aramco. It's an entirely plausible story, right? ISIS takes over Saudi Arabia, nationalizes Aramco. What do you think your equity is going to be worth? Zero. But let's make it a more realistic scenario. Let's say there's a 20% chance of regime change. And if it happens, you won't lose the entire company, but you're going to have to give up more cash flows. The new regime is going to demand a bigger slice of the cash flows. I actually valued Aramco twice. Once with the House of Saud staying in power, once with regime change, and my expected value was 80% times the value with the House of Saud staying in place, 20% times what you'd get as a value of the regime change. This is the way to deal with discrete risks. Is rather than try to force it all into the discount rate, do two valuations. Same thing with nationalization, take the expected value. It's a more effective way of dealing with these kinds of risks than trying to force it into the discount rate. Any final questions before we end for the day? Just a reminder, we're almost done with packet 1. So next session, we're going to start with packet 2. So please download packet 2. And you can download packet 3. Packets 2 and 3 are much slimmer. So you can download them both and make it into one packet. But go online and download those because we will be starting on those on Wednesday. Okay. That's it. I will stop.
Can I ask a quick question?
Sure, absolutely.
Yeah. I made a note here about you know the company JD, of course. Yeah.
Mm-hmm. JD.
Yeah. So yeah, because I was thinking about the thing you said about for example, when somebody is when somebody is sugar daddy to the company, I found that pretty funny. But it's that you affects something like margins. Because there's this company Dada, which has software for them, right? And Dada has been I've been seeing them since their IPO, and they're falling, they went up, they fall now, recently, and I was thinking of getting in again. I didn't do any valuation.
Just be careful, right? Because is there a primary customer JD? Is that how they make money? So
they're pretty big on.
When you get most of your revenues from a single customer, same thing. I think somebody told me about a Polish company today. That is, it's a company that deals with online retailing, and because Amazon is entering Poland and this company's primary customer is Amazon, people are bidding up its price. But we know the history of companies. They get almost all their revenues with Amazon, right? What does Amazon eventually do to these companies?
Buy them out.
It chews them up and spits them out, basically. It's basically, it's a mixed blessing. With Amazon, they're going to drive a hard bargain. It's like having Walmart as your lead customer, right? You get the locked-in revenues, but your margins are going to get slimmer over time because you've essentially locked out any kind of bargaining power. So when you value a company like that, that is really your concern, is what kind of bargaining power you have. And I'd be wary because you're completely at the mercy of JD.com setting prices. And where are you going to go? What choice do you have, right? And that would be my concern. Maybe we can get some evidence that they have other businesses they're building, because the more they can build other businesses and the stronger they can get. But until you see that, you've got to be wary about their margins.
Yeah, so when it's let's say a monopsony kind of deal, you only have one buyer, then you have to
be more. Yeah, exactly. In fact, when you have one buyer, you might have to do two valuations, one with just that buyer and one without the buyer, right? I often do this with companies dependent on Walmart. You get 60% of your revenues in Walmart. I'll do a valuation with that, and then I ask what will happen if you lose Walmart. Now, obviously, the numbers are going to look very different, but as an investor, I've got to be open to the possibility that this could change, right? It's not guaranteed that you will stay with that customer.
Yeah, thank you, Professor. That was my question.
Welcome. Any other questions, folks? Tim, you have a question?
I have a quick question. I was looking, I'm doing a part-time internship right now, and then I'm seeing this weird report that a company like an investment bank in in America just added like a 2% risk premium for South Korean company, and it just says like they just added this 2% because of the war risk. Like how does that work? Like is that a normal thing?
See, analyst who probably wrote this has probably never been in Seoul.
Yeah,
South
I mean,
Korea, right? I mean,
but,
in a sense, nobody in Seoul is sitting around saying there's a risk of war tomorrow. I mean,
yeah.
it's an ever-present issue, right? Because let's face it, on your northern border, you have the most unpredictable neighbor in the history of the world, right?
Yeah.
So you got to worry about that. But I would argue that you should probably be punishing Vietnamese companies. And you think that, that North Korea is just going to say, look, I'll send the missiles only this way. They don't even know where they're shooting the missiles. So if you want to attach this war risk, you should probably be attaching it all over South. And why stop at Southeast Asia? You think the US is going to be unaffected by a nuclear missile? That it's silly. It's silly because it's a very sloppy thing to think about, right? So if you want to bring in something explicit, it's got to be something well thought through. So
can I just ignore this risk premium, like war risk premium?
Are they including any kind of risk premium for Korea? Because South Korea does have some risk. I mean, there is that default spread, and so this might be just
But
so
like
this
in addition to a country.
I would absolutely ignore it.
Okay, that's because like that risk premium actually played a big role in like my valuation process. So I just get rid of that and then just give it
because it's not a country specific, it's a global issue.
Yeah, but
we all face the issue of North Korea going off the tracks. But let's say if they do fire a missile that actually hits something, God forbid, you think the NYSE and the S&P 500 will not collapse? I mean, this is going to be a global disaster. So if there's a risk premium, this is something you worry about is North Korean, the war. I think it's a global issue. Korean risk around the world go up. It's not just a Korean issue.
Okay.
And the very fact that they think it's a Korean issue suggests to me that they understand neither finance nor geopolitics.
Okay. So based on your reaction, it's not a normal thing to add, additional.
I've never seen somebody do that with a Korean company. It's the first step for everything. Yeah.
I see. Thank you so much.
Okay.
Thank you.
That wouldn't be included in the country risk?
Well, that's a question, right? I mean, it's a factor, but I don't think that Moody's is actually penalizing. South Korea is actually a fairly high rating. So there's country risk. It's not specific to South Korea. I mean, that's, I think, the reasonable. I mean, this is a risk around Southeast Asia, right? And I'm not even sure it stops at Southeast Asia because, it's a global risk problem. This one rogue country that can essentially fire missiles off in every direction. Okay. So I don't think that Moody's penalizes South Korea for having North Korea as a neighbor. It might be more, they share the same, parts of the same country, but I think we're all exposed to that risk.
Okay. All right. Sounds good. Thank you so much.
You're welcome.
Have a good one.